You hear it every single day, right? That one number that's supposed to tell you if the stock market is up or down. But what if I told you that behind that number, there are all these invisible risks that can trip you up, and a hidden architecture that most people never ever see? Well, today, we're pulling back the curtain. We're going to crack the code on those hidden risks and demystify the single most important tool we have for making sense of it all. Let's dive in. I mean, just think about it for a second. You've got thousands of companies, millions of trades happening every minute, and trillions of dollars flying around. It's pure chaos. So how in the world do you boil all of that complexity down into one simple number that actually means something? It sounds impossible, right? Well, that is the exact problem that a market index was invented to solve. But before we can really appreciate how we measure the market, we first have to respect its hidden dangers. Because let's be honest, in the world of finance, it is almost always what you don't see that ends up hurting you the most. So anyone who's in the market, especially when you get into more complex stuff like derivatives, is basically navigating a minefield of risk. And most of these risks, they fall into 5 big categories. Getting a handle on these is absolutely key to understanding the whole picture. Okay, first up, you've got counterparty risk. And this one's pretty simple, actually. It's that gut punch feeling when you realize the person or institution on the other side of your deal just isn't going to pay up. They default, they walk away, and suddenly you're left with nothing. Then there's liquidity risk. And this quote just says it all, doesn't it? You own something, you think it's valuable, and you decide it's time to sell. You go to the market, and it's crickets. There is literally no one there to buy it from you. Your asset is trapped. That terrifying feeling of being stuck, that's liquidity risk. You just can't get out. And oh, the dangers do not stop there. You've got legal risk. This is when the rules of the game just change right in the middle of a play. A government might ban a certain product, and poof, your whole strategy is gone overnight. And then there's operational risk. This is when the system itself just breaks down. A server at the stock exchange has a glitch, trading halts, and when it finally comes back online, pure panic can set in, all because of a tiny technical failure. So with all these different risks swirling around, how does anybody make sense of this whole thing? How do you take the pulse of such a complex and, honestly, a kind of chaotic system? Well, this is where the simple but incredible power of an index comes into play. So what even is an index? You can think of it as a clever little tool. It takes a huge, messy basket of stocks, like, say, the 500 biggest companies in the US, and it uses a smart formula to boil all their ups and downs into one single, easy-to-follow number. Its entire job is to turn all that financial noise into a clear signal. I love this analogy. Imagine you wanted to know if samosas were getting more expensive across India. You're not going to track the price in 10 different cities, are you? No way. You'd create a samosa index, one number that tells you, on average, if the price is going up or down. A stock market index does the exact same thing, just with company shares instead of delicious snacks. Okay, but here's something that is absolutely crucial to understand. How you build that index. It matters a lot. The math you use to calculate it can totally change what that final number is actually telling you. They are not all created equal. So there are 2 main ways to do it. Most of the indices you hear about today, like the S&P 500, are market cap weighted. It's pretty simple. The bigger the company's total value, the more it can move the index. Makes sense, right? But the older way is price weighted. And here, only the stock price matters. And this can be so misleading. You could have a company with a $1,000 stock price that completely dominates the index, even if it's a tiny company compared to a giant with a $100 stock. You can see why that's not really the best approach anymore. Okay, so we've looked at the big picture, the whole market. But now let's zoom all the way in, down to a single trade. Because it's right here, in the simple act of buying and selling, that we find a hidden cost that catches pretty much everyone off guard. It's called impact cost. Let me ask you this. You're looking at your screen and you see a stock is trading for, let's say, $95. You decide, okay, I'm going to buy 100 shares. Do you think you're actually going to pay exactly $95 for every single one of those shares? The real answer, which might surprise you, is almost always no. And to understand why, you have to peek behind the curtain at the market's order book. This is the live auction right now. On the left, you've got the bids. That's all the people lined up waiting to buy and the prices they're willing to pay. On the right, you have the asks. Those are the people waiting to sell. And you'll notice the lowest seller's price is always a little bit higher than the highest buyer's price. That little gap, that's called the spread. So, when you hit buy for those 100 shares, your order jumps in and starts looking for sellers. First, it grabs the cheapest ones available, those 30 shares for sale at $952.90. But you still need 70 more. So your order moves up to the next price level and buys those 12 shares at $953.80. Then it has to go even higher to get the last 58 shares at $954.05. You see what happened? Your own order was so big that it literally ate through the available supply, pushing the price up against yourself as you bought. And that extra little bit you paid averaged out over all your shares, above the price you thought you were going to get, that is your impact cost. It's the price you have to pay for liquidity, for getting your trade done right now. In this example, it was like a hidden fee of 0.13%. You could almost say it's the market charging you for making a splash. So we've gone through hidden risks, we've gone through hidden costs. Now let's tie it all together and talk about why an index is one of the most powerful ideas in finance, not just for Wall Street pros, but for you, for me, for everybody. When you get right down to it, indices do three really important jobs. First, they're like an economic barometer. When the S&P 500 is going up, it's usually a good sign for the US economy. Second, they are the ultimate benchmark. It's the yardstick we measure everything against. Who cares if your fund manager got a 12% return if the index did 14%? And finally, they are the absolute foundation for derivatives. A huge multi-trillion-dollar part of the financial system is built right on top of these simple numbers. And if you want proof of just how important these index stocks are, just look at this chart for India's Nifty 50 index. Out of thousands of stocks on the exchange, just those 50 companies make up a whopping 28% of all the trading value. It shows you exactly where the money, the attention, and yeah, the power is all concentrated. So, I'll leave you with this question. Now that you've seen the hidden risks, the hidden costs, and the clever tools we've built to measure it all, how does that change the way you look at a simple buy or sell button? It's a pretty good reminder that underneath every single trade, there's a deep, powerful, and absolutely fascinating machine.